Hello, everyone. Thank you so much for joining us. My name is Jordan Ben-Shia. I'm the Executive Director of the VIN Foundation, and we are thrilled to be partnering with VCA for this Climbing Mount Debt Repay Wiser webinar. And we have Joanna Baldwin here from VCA, and myself and Dr. Matt Holland, VIN Foundation board member. We're going to be sort of behind the scenes, and I'm going to go through a couple housekeeping tips with you before I introduce our speaker, Dr. Tony Bartels. There is a Q&A button at the bottom of the screen. If you have any questions throughout the presentation, about something that Dr. Bartels is speaking about, please use that Q&A, and you can ask anonymous questions. They are not tracked. But you have a phenomenal resource here in Dr. Bartels, so please feel free to ask questions throughout. And I will be throughout the presentation bringing up those questions as they're pertinent. We will make sure that all questions are answered. So if we don't get to them at that moment, we will get to them at the end of the presentation. If there are any technical issues, you can go ahead and put those in the chat window. But everything else, please go ahead and use the Q&A. This webinar will be recorded and Joanna will be sending it out. There also is the option for CE credits if you'd like them. And Joanna will be sending out information about that as well. So go ahead and use the Q&A for any questions that you have. Again, we really encourage them. If you have a question, I assure you someone else probably has that exact same question. So we'll be working on answering all of those live. And with that, I'm going to turn it over to Dr. Tony Bartels.
Thank you, Jordan, and thank you, Joanna and VCA, for pulling this all together. I saw some excellent questions that you all submitted prior to the session in your registration. And for those of you who filled out the student debt and income signalment form, thank you for doing that too. That really helps. I have a lot of that information that I can aggregate and share with you this evening. I did also pepper some of the questions and concerns that you submitted through there throughout here as well to make sure that I cover those topics, but also just to let you know that other people are thinking some of the same things. I saw a lot of really good questions in there, and I do expect some tonight, particularly and especially from those of you who have private loans or who graduated a little bit ago and may not have utilized or had access to some of the income-driven plans that we have. You know, there's a lot of reason for me to believe that there's going to be a lot of questions in terms of repayment plans and options going forward, just based on what I saw from the information that you saw submitted prior to this session. So feel free to go ahead and ask those. Like Jordan said, you can even submit those questions anonymously, so nobody will know who you know, who's asking that, or they won't see that. That's the nice part about these webinar formats. All right, but we're gonna dig in tonight, and then I'm gonna, you know, use this as kind of a way to stay on track. I'll get a little bit more into my signalment, if you will, my student debt signalment. But tonight I want to try to, you know, make this as clinical as we can, right? Because that's how we relate to things best. So we're going to do a physical exam and diagnostics of our student loans. That's really what that student debt and income signalment form is all about. So we're, you know, as we're going through the presentation tonight, you're going to see, for those of you that took a stab at that, you're going to see why I asked the questions on there that I asked, right? Because all of those items are going to play into what is the best repayment strategy for you when it comes to your student loans and some of the other debt that you all reported having. So when we do that physical exam, those diagnostics, those are what's going to let us develop those treatment plans, right? What is the quote best repayment strategy? That's going to be our treatment plan for our student loans and any other debt that we're dealing with. There are going to be side effects regardless of the pathway that we choose, whether we're using an income-driven repayment plan, whether you're using a standard, extended, or even a private loan refinance. All of those strategies have side effects associated with them, right? So we're just going to lay those out on the table, and you know, we basically have to pick the treatment plan that's going to have the fewest side effects, or at least ones that we know how to deal with, right? So we'll talk a little bit about that. And then prognosis, kind of looking, you know, farther down the road. What does student loan repayment look like long term? When can you expect to be done with student loan repayment? And then we'll finish up and also incorporate some financial wellness items in there, things that you should be doing along with paying back your student loans, right? And that's a lot of the questions I saw or concerns I saw from you all had to do with, how do I build a retirement savings, or how do I buy a home, or how do I navigate a mortgage and my student loan payments, simultaneously, right? And we're definitely going to talk about that, right? Because we're going to have to figure out a way to do it all together, right? We can't take a station approach where I'm going to finish paying off my student debt before I start saving for retirement, right? That's going to take too long. So we're going to have to figure out a way to do all of those things together, and we'll talk about some tips and tricks to make sure that that happens. Overall, this is all about reducing your stress and hopefully helping you improve your loan repayment success, right? So, loans are kind of one of those just ugly things that we deal with. Side effect, if you will, of becoming a veterinarian in the 21st century, some pretty stiff student debt. But there are definitely ways that we can handle those and treat them appropriately, and have a robust financial wellness plan alongside of that. Just from this information alone, this is kind of the spread of the folks who took a stab at doing that student debt and income signalment, what year you graduated from. I mean, just from this information alone, I can tell that there's going to be a lot of different approaches taken, right? Because a lot of things have changed since, let's just use the earliest year here was 2007. A lot of things have changed since 2007, again in 2010, hugely in 2012, again in 2015. This is kind of when we started adding and expanding upon the income-driven repayment options that are available. So for those of you that graduated, 2007, 2010, before 2012, there were very few options available. And since 2015, we've had even more options available. So we're going to make sure that you have at least checked to see if you're eligible to use some of these more beneficial plans that are available now. And if not, if there is another plan that you might be able to use, even if you graduated, more than 10 years ago. Also, the range of debt that you submitted to me was anywhere between $48,000 and in excess of $400,000, right? So, we've got everything here from a, really nice car payment to a really nice house payment, right? So these are obviously going to have different strategies associated with them. Somebody who has $48,000 of student debt is going to have a much different student loan repayment strategy than somebody who has $400,000 of student debt, right? So we're going to make sure that we know, generally which are the best types of repayment strategies to take depending on where you fall in the debt range. Okay, so I asked you to share with me a little bit about your student history and signalment, and so here's a little bit about mine. So I'm a married two-vet household with no kids yet. My wife finished Colorado State before I did in 2009, and she went on to specialize in small animal internal medicine, and she practices where we live here in Denver, Colorado. I went the GP route. I did a combined MBA, DVM. This is kind of a second career. Veterinarian. I came from engineering and corporate finance, so I was already a bit of a numbers geek before I found myself doing this. But I also thought I was doing all of the right things to make sure that I borrowed as little as possible as I was getting my veterinary education. But then I met my wife, who had more student debt than I did, and together we have more than $400,000 of student debt. So I'm very familiar with the high end of that range. So when we graduated, we had to figure out how are we gonna manage this, right? And basically, if you did nothing after you graduated, many of you found out that they put you into a standard 10-year repayment plan. Some of you are still using that, and that's fine, right? As long as you have the income and the resources to support it. That's kind of how student loan repayment was meant to work, and that's why it's a default repayment plan. You weren't really meant to spend more than 10 years paying back your student loans, but things have obviously changed. So $4,500 a month for us was more than we were earning, right? So there's no way that we could have stayed on the 10-year repayment plan while my wife was navigating her residency and I was just getting started. I mean, it just wasn't in the cards. So stumble upon these income-driven repayment options. And as the name implies, the payments are a function of your income. And many of you indicated that you're using those. Some of you even indicated you're using IBR. That's the one we started using, right? So this is one of the older ones. The first versions, if you will, of income-driven repayment was income-based repayment. That's one of those plans. So the payment is a function of your income. That had us down to about $1,400 per month. We have since switched to one of the newer plans that's called Revised Pay as you Earn, and that got us down to $930 per month. So a little bit more manageable here. This is what allows us to have a financial plan, a financial wellness plan that involves something other than paying down our student loans. And we've been able to buy a home, buy a second home, save for retirement, save for the forgiveness that we anticipate reaching, right? So we're going to talk a lot about that tonight. And then, oh, by the way, the pandemic, kind of throws a monkey wrench in all of this, right? So for many of you, especially those of you that have federal student loans, have noticed that your interest has been shut off, your payments have been shut off. Many of you are still making payments. We want to make sure that that's a good idea, right? It depends on what kind of repayment strategy you're using in terms of whether or not it makes sense to continue to make payments while your interest is shut off, your payments are shut off. One of the really beneficial things for those of us who are using income-driven repayment during this pandemic relief period is that this forbearance time counts towards forgiveness, right? So not only are we not accruing any interest and we don't have to make any payments, the clock is still ticking, right? Which is great because it's essentially just accelerating that time between when we started repayment and reaching forgiveness, right? So that's a huge benefit for those of us that are actually, paying based on our income and anticipating hitting forgiveness. So currently we're paying the minimum that Repay requires, and right now that minimum is zero, right? We haven't had to make a payment since March. That's been great. We've been able to do other things with that income. It's been easier to make sure that we max out our retirement options that we have available to us. We've boosted our forgiveness savings plan, and we're 65% of the way to our tax target with about 16 years before we hit it, right? So what this essentially means is we're ahead of schedule, right? So my goal is to try to reach that tax target probably within the next few years, and then adjust from there, right? I won't have to be as aggressive with it. We can just kind of sit back, and we don't have to contribute to it if we don't want to anymore. We would only have to make minor adjustments based on whatever it is we think that anticipated tax is going to be. And I'm going to show you guys how we figure that out, right? So what tools we can use to walk through that, and some of the other options that are out there for helping you save for forgiveness, because that was another one of the common questions that I saw come up throughout the student debt and income signalment forms. So if you have federal student loans, we're going to make sure that you know how to do this physical exam, right? So one of the first things we're going to do here is just make sure that everybody knows how to obtain their student aid data file. Some of you, I figured that out, right? Because you submitted it with your student debt and income form, but others of you submitted that form but didn't include the file. That usually means that you're not really sure how to find that, and that's fine. It is quite confusing. So we're gonna come over there and do that right now. So a student aid data file is available on the federal student aid website, right? So those of you who have graduated not too long ago, this is the same portal that you use to apply for your student loans. For some of you that graduated a while ago, this is the new version of essentially what your FAFSA PIN was, right? So now you're going to have to create a login using either your FAFSA PIN or your social security number if it's been a while since you've accessed this system. But you can do that. Even if you graduated a long time ago, you can reactivate or create a federal student aid login that will be tied to your social security number, and then we'll show you all of the ugly details behind the federal student loans that you've borrowed throughout your higher education career. So this is the new version of it. This iteration of it is only about a year old. It's a lot nicer than it used to be, right? Everything is under one roof now, which is great. It used to be scattered all over the place. So I'm going to log in with my ID here. You guys will get to see what the share of the balance is remaining of our total household student debt, at least for the federal student loans that I have. So I have about 171,000. 164 of that is principal. 7,800 roughly is interest. This is unpaid interest. I asked about that in the student debt and income signalment form. I do find that most people struggle to know the difference between their principal and unpaid interest, particularly if you're using income-driven repayment. This is a feature, not a bug, of income-driven repayment. For many of us, we end up making payments that are less than the interest that accrues. which means you can end up with an unpaid interest balance. The nice thing about the federal student loans is this interest doesn't cost me any more interest. And we'll talk about that later. But one of the reasons why income-driven repayment can be so beneficial is even if I'm not making payments that cover the interest, I don't get charged any additional interest on that interest. I only get charged interest on my principal. So if I keep this unpaid interest in that unpaid interest bucket, I won't ever accrue any additional interest on it. All right, but we're getting a little sidetracked here. We're looking for that student aid data file, which is under this view details link. So if you're in here, this is pretty much the dashboard, they call it. If you click that view details, it's going to take you to another page that has a little bit more detail, but not quite enough. This is the link you're looking for, right? So download my aid data, right? So this is going to generate this ugly looking text file that has your entire higher education borrowing history in it for the Title IV loans that you may have used, right? So this is how you click on that. I already have several of mine on my computer. I don't need to download it again. But if you hit continue, it'll download that text file onto your computer. All right, then we're going to save that somewhere where we can retrieve it. We're going to come over to the VIN Foundation Student Debt Center. So these are a lot of the tools that that Paul Payan, the co-founder and CEO of VIN, have spent the better part of almost 10 years now developing. And it's designed specifically for veterinarians. Anybody can use it, right? This is a publicly available website, vinfoundation.org, but it's designed specifically for veterinarians, right? So even whether you're a VIN member or not, you have access to this, all the tools that we're going to go through. We're going to take that student aid data file and we're going to come over to the My Student Loans tool. Right, you're going to have a few options here. All of you fall into this. I've graduated. Right, so you're in the repayment category. Where did my open up in a different screen here? And I've got several of these that we're going to go through tonight. Right, so I'll just pick one here. Actually, let's go with this one. This person graduated almost 10 years ago now. It's amazing how fast that time goes by. So about $260,000 of principal. Here we have some unpaid interest, right? So I can tell that this person is probably using an income-driven repayment plan. You can also end up with unpaid interest if you are in deferment or forbearance. But at the end of that deferment or forbearance, they'll take that unpaid interest and add it to your principal. But they don't do that in income-driven repayment, right? So here we're going to see there's a difference there. We know what our total is. We see that the interest rates are shut off. Just prior to the interest rates and the payments being shut off, I can see that the payment for this person was $799 per month, right? So I can see that they were using Repay, so the same plan that my wife and I have been using, right? And then the really valuable, one of the really valuable tools in here is this income-driven repayment eligibility tab, right? So income-driven repayment plans have some really strange qualifications, and they're based on the types of student loans you have and when you started borrowing, right? So this person has a very similar situation to my wife and my situation, right? So they are eligible to use the earlier version of IBR, the same one that we started off using. They did not meet the pay-as-you-earn requirements. Same for my wife and I, right? We didn't meet this quote new borrower requirement. So if you had student loans from before 2007 and you didn't pay them off to zero before you started borrowing again after that time frame, then you won't be eligible for pay-as-you-earn, which is unfortunate because pay-as-you-earn tends to be one of the most beneficial repayment options available, right? But for those of us who are not able to use that, we tend to lean on revised pay-as-you-earn, right? And that's the plan that this person's using. That's the plan my wife and I are using. But it does have some quirks, right? It's not the exact same as pay-as-you-earn, and we'll talk about those details just in a little bit here. But please grab that file if you haven't already. Try uploading it into the VIN Foundation My Student Loans tool. This is really kind of the nuts and bolts of the beginning of that physical exam of your student loans, right? You want to make sure you understand everything that's in here, right? We can see this person had 17 different loans, right, that still have a balance on them, right? This is one of the things that makes repayment so difficult, right? Is you tend to see like, oh my God, I got 17 different loans. How do I know, how do I attack this, right? And thankfully, a lot of this is kind of automated, right? This not when we are in repayment, this $799 gets proportionately applied across all of these different loans, so you don't have to really make that decision. Now, if you do make extra payments, right, then there might be some strategy involved. But when you're talking about 17 different loans, it's going to be pretty tough to strategize that, right? And some of us might have consolidated our loans, right? So we don't have 17 anymore. We've only got one or two left. So all of those situations are going to factor into our overall loan repayment strategy. If you're not sure who your loan servicer is, right, this will show us. So I know we've got Mohila for this particular person, right? So there's a lot of different loan servicers out there. You still have federal student loans, but they're just serviced, meaning the Department of Education contracts with, I think it's 13 different loan servicers who take those payments from you and process that, documentation if you're using income-driven repayment and stuff like that. They're the ones that answer the phone when you have those questions. They're also the ones that are probably giving you the wrong information most of the time when you ask them questions. So you have to be a little bit careful with those. All right. So let's dive a little bit deeper into this physical exam. So we want to make sure that we know our loan types, right? So the types of loans we have is one of the most important parts of student loan repayment, right? So what are those loan types? Direct loans. If you're, if you were in school before 2010, you might have what are called the federal family education loans, which are kind of the precursor to direct loans. Some of you have some health profession student loans, and then others have private loans, right? So how do you know the difference? So the loan types, all of those loan types that are found in that student aid data file are definitely federal student loans, right? No doubt about it, right? So because they're in your federal student aid, my student aid file. The names of those and the subtypes of those loans are going to be important when it comes to the repayment plans. The interest rates, depending on when you started borrowing, they may be a little bit higher. They've been a little bit lower recently, even before they turned them to zero for the pandemic. And then the repayment plan types that you're using, you want to be really familiar with those, whether you're using income-based repayment or revised pay-as-you-earn or maybe an extended graduated. I do find that people tend to call all of the income plans income-based repayment, and that may not be the plan that you're actually using, right? Income-based repayment is actually a specific type of plan that falls under that umbrella of income-driven repayment plans. And sometimes income-based repayment is not the most beneficial plan, right? So you really want to know which one you're using, so you know if you're using the most beneficial one. Your minimum monthly payments, like we just looked at, what does the loan servicer or what does the bank require me to pay in order to stay in good standing on that loan, right? And that's essentially the minimum monthly payment, right? So we want to know what that minimum monthly payment is, and then we'll account for anything we're paying above that later. If you're paying anything above that, it doesn't always make sense to do that, but we'll talk about that too. Terms and conditions for the federal student loans, the terms and conditions are pretty much all the same. When it comes to your direct loans, if you've consolidated your loans, you have all direct loans, like I showed in that previous example. The terms and conditions for those direct loans are identical, right? So anybody that has those direct loans has the same terms and conditions. If you have other types of loans, they're going to have different terms and conditions, right? So you're going to want to look for those terms and conditions. They're no fun to read, but particularly if you have like a private loan, you want to look at what are those terms and conditions? How long am I going to be in repayment? If I have a interest rate that might change, what are the conditions around the change of that interest rate? If I want to pay the balance to zero faster, some private loans don't even let you do that without penalty. If there's a cosigner involved, you want to know what their responsibility is. If you can't make the payments, right? There's usually clauses in those terms and conditions that talk about what happens if you can't make the payments on time, right? So the terms and conditions are really, really something you want to get familiar with for any of the loan types that you have. So what's the difference between federal student loans and private student loans, right? So these are some of the common federal student loans. So direct loans, there's a whole suite of subtypes in the direct loan family. These were the precursor. So this is the federal family education loans. These are the ones that predated direct loans. So if you were in higher education at any point before July of 2010, there's a good chance that you have these federal family education loans, right? So that's where that graduation date is really important. Perkins loans are no longer available, but I do find them to be a common loan type that many, not so distant graduates of veterinary school have. Health profession student loans, another very common type of loan that graduates from state veterinary schools have. Loans for disadvantaged students are another loan type that I see not so infrequently, is a type of federal student loan. These three, the major ones here, these are the Title IV loans. These are the ones you're going to find in that federal student aid website, right? Some of these other ones are still federal student loans, but they're not in that system because they fall under a different title in the Higher Education Act. So this is just part of the messiness of student loans. But they exist outside of that system, but you can't account for them, and you can make them eligible for some of the more beneficial plans if you want to. Although for those of you that are graduated and been out in repayment for a while, it's probably not all that important or crucial that you do that at this point. For private student loans, it's really going to depend on the bank that you took it from. Like every one of those are different. This might be Wells Fargo, Discover, Sallie Mae, you name it, right? The list is really, really long. They're likely going to have an online account that you can log into. Hopefully there's a master promissory note or some kind of terms and conditions, the contract that you signed, that you can pull up and review all of the details on those particular loans in that portal. If you're not sure and you have this nagging feeling that you've lost track of a particular loan, then check your credit report. Right? This is a really good habit to get into. Your federal student loans are going to be on your credit reports. The private student loans are going to be on the credit reports. And the good news is you can check a credit report from the three major reporting entities for free once per year. Right. So I check one from all of the three major reporting entities, usually around this time of year, kind of when I'm filing my taxes. I just want to know what's on there, right? I want to make sure that I'm not missing anything and there isn't some delinquent account that I lost track of, or, when they talk about identity theft and people opening accounts in your name, right? This is where you're going to find stuff like that. The banks are going to use this too, right? So if you're going to go buy a home or buy a car, rent an apartment, buy a practice, they're going to look at your credit report, right? So you want to look at it first so you know what's on there. And if there's anything that you want to fix, you can do that before the bank sees it, right? The worst feeling in the world is if the bank's, like, what's this? And you're like, I don't know, right? That should never happen, right? So check your credit report. So you can know everything that's on there and make sure you identify things that you don't recognize or seem like they shouldn't be. It can take a little time to remedy that stuff too. So you want to, give yourself some time to do it. You all told me that, and this is a pretty normal distribution, if you will, for student loan portfolios, right? So greater than 80% of you had U.S. student loans. A few of you had health profession student loans. A good chunk of you have private student loans. And then there's always this other category. And some of the stuff that fell into the other um, are federal student loans, right? So graduate plus loans are either a direct or FFEL type loan, right? So direct grad plus loan or a FFEL grad plus loan. These are federal student loans. So these technically belong in this category. This person that mentioned previously federal loans consolidated into a different bank, Navient, be careful there, right? Because Navient is a loan servicer, and prior to 2000, let's say 13-ish, they used to move loans around a lot, right? I had this happen to me. So I used to have Navient with my student loans, and they moved over to Great Lakes, right? It just happened. It could be that you have federal student loans that were moved from one servicer to another. Now, Navient, formerly Sallie Mae, right, also provides private loans. So it could also be that those are loans that were consolidated into a private loan and are now serviced by Navient. Right? So you really have to dig a little bit deeper in there and see if those are federal student loans that are just serviced by Navient, or if they're actually private loans that used to be a federal student loan. Sallie Mae, Sallie Mae, if it's a true Sallie Mae loan, those are all private loans. So Sallie Mae doesn't any longer hold any federal student loans. They only hold those Sallie Mae private loans. So this is definitely a true private loan. And then we do have a lot of folks who often have family arrangements, so they're paying back their family instead of paying back a bank or the Department of Education. But those, anything with those Grad Plus loans, they will be in that student aid data file. So you'll find those if you go through that exercise as well. Okay, so PPE. My version of PPE is Plan Payment Eligibility Check. All right, so what are your current repayment plans? What ones are you enrolled in and using now? What are those current minimum monthly payments? How much are you paying above the minimums? If you're paying anything above those minimums, that would include any additional payments you're making now during the pandemic relief period that our federal student loans are in. Are you eligible to use other repayment plans, either ones that you may not have known about or have come online since you entered repayment? That is a pretty frequent occurrence. Again, we've added a lot of different repayment plans. Pay as you earn came online in 2012. Revised Pay as you earn came online in late 2015, early 2016. Right, so new plans have been added since many of you have graduated. And there's even talk now of potentially adding another one. So there could be some new plans on the horizon, depending on what happens with the new administration. And then we want to also look at how much should we pay, right? That's usually, the question everybody wants to know. How much should I pay? How do I get out from underneath my student loans as fast as possible? All right, so just a quick review here, just making sure we have that student aid data file, uploading it into the VIN Foundation My Student Loans tool, and then checking that income-driven repayment eligibility tab. I do want to do another one of those here, right? So I've got, that's a person that's using Repay. Got another person here that qualifies. This person's actually using Pay as you earn. Right, so a little bit more recent graduates, so 2016, 4 years ago, almost 5 years ago now. So here we go. Here we see again, unpaid interest, right? So that's kind of my first tip off that somebody's using an income-driven repayment plan. We do see that all the interest rates here are set to 0. There's 10 different loans serviced by Great Lakes in this case. The payment before they went into the pandemic relief period was $465 per month. They were using Pay as you earn as the repayment plan. In this income-driven repayment eligibility, you're going to see here, so Pay as you earn, clearly they qualify for it, they're using it, right? So that's good news. So definitely check and make sure you know which income-driven repayment plans you're eligible to use, right? That's going to be the steps you're going to take to do that. I got a question here. If you switch to a different income-driven repayment plan, say from IBR to Repay, does the time to forgiveness restart? It does not, right? So the clock does not restart. However, that is one of the triggers where they'll take this unpaid interest and add it onto your principal. So let's say for some reason this person switched from Pay as you earn to Revised Pay as you earn, right? There really wouldn't be a good reason to do that. But if they did, that this unpaid interest would get added to this principal, the clock would still stay the same. So presuming they've earned 4 years of qualifying time towards repayment right now, that time would still be preserved. So the time until they reach forgiveness would still be whatever the maximum repayment period is minus the time they've already spent in that plan, but the unpaid interest would get capitalized. Now we do factor that in the simulator, right? We'll get to that in a little bit, but you can take this information, send it over to the simulator, and if you indicate that you're using one plan, if you want to compare it to switching to another one, we'll factor in that unpaid interest getting added to the principal. Sometimes it'll make a difference, other times not, right? It really depends on how much unpaid interest we're talking about, what your income is, and how much time you have left before you would reach forgiveness. Good question. All right, just to make sure everybody has seen the recent release from the current administration, the new administration regarding student loans. So kind of just a quick history. In March, we had the, when the pandemic was just rolling out, the CARES Act came online, and it was due to expire earlier this year. And then by executive action from the previous administration, they extended that. And then ever since then, it's been a series of executive actions that have continued to extend pretty much what the CARES Act did via legislation. So that has set the interest rates for all federally held student loans to zero. It has turned the payments off for those loans for that duration. And it also provides credit towards forgiveness for anybody who's working towards forgiveness under income-driven repayment or for public service loan forgiveness. That suspension has been extended through at least the end of this September, which is way longer than I would have guessed. But we'll see. I mean, who knows if they'll even extend it beyond there? That's a long time, right? So we've had student loans, the interest and the payments shut off for, it'll be more than a year in March, and it's going to be, March, whatever, another 6 months, so 18 months of not having to make payments, and not accruing interest, but yet still counting towards forgiveness, which is, again, it's huge. It is a huge benefit. Laura asks, can you stay on Repay for 19 years and then switch to Pay if you qualify, then qualify for forgiveness after 20 years, but it won't affect you for very long? Yeah, that's a great question, and I'm going to hold on that one until I show everybody some of the features of the different repayment plans. I used to think that would be a good strategy, but mathematically, I have not found a scenario where that actually is beneficial, right? So it's kind of an academic theoretical kind of thing that you could do, but I'm not sure if it's actually going to save you any money. So we'll talk about that more when we get to kind of the feature set of the different income-driven repayment options, which is actually coming up here quick. So remind me if I don't talk about that one in just a few minutes. But there's two primary ways that you can pay back your student loans, right? So they're roughly categorized by time or by your income, right? And this is really unique to your student loans, particularly your federal student loans. So you can choose to pay on a time-driven. A time-driven is essentially a traditional repayment plan, like a standard 10-year plan, or a refinance, or a 30-year, like a 30-year mortgage kind of thing. Those are all based on time, right? So the time that you decide to pay it back, the interest rate that you're being charged, and the principal balance, right? So that's going to generate a payment that's going to extinguish that balance in the specified period of time, right? So that's pretty much how every loan outside of these income-driven repayment options for federal student loans, that's how every loan works, right? So you can choose to pay your federal student loans with a time-driven option. Every private loan has a time-driven option, right? They don't have income-driven repayment options. So this income-driven stuff is really unique to your federal student loans only. And these are kind of the suite of plans that are available. So there's two versions of IBR now, depending on when you graduated, Pay As You Earn, Revised Pay As You Earn, and then there's even an older one that started in 1994 that almost nobody uses. This was kind of the version 1, if you will, of income-driven repayment in this country. And it just really wasn't a very good attempt, but it is the foundation for all of the rest of these, right? So I'll show you that in the IDR features here. But nobody uses this because it doesn't generate a very beneficial payment, right? So they can usually get a more beneficial payment either in a time-driven plan or one of the newer income-driven plans. And the major difference long term is what happens to your interest, or can you wrap your head around the fact that you may not have a loan balance of zero at the end. You may instead hit something like forgiveness and have to pay the tax on it, versus a time-driven plan where you're going to pay the balance to zero and there's some comfort in knowing that, but the monthly payment and how much you pay in the end may be more than you would pay if you paid based on your income and plan for the tax, right? So that's really the exercise here, is how do we figure out which one is going to be the most beneficial for us in not only the short term, but also the long term.
Hey, Tony, we had a question just come in, and it refers back to what you were talking about a couple minutes ago. So I just want to, so is it a good idea to keep paying the monthly minimum, even though it is paused?
Yeah, that's a bit of a loaded question. It depends, right? It depends on the repayment plan that you're using, right? So if you want to share, I would say that what the metric that I would go through is, am I using an income-driven repayment plan? And if the answer is yes, then there's really not a good reason to make any payments during this suspension period. The next thing I'm going to want to know is, how do you feel about your overall financial wellness, right? This is a excellent time to maximize your retirement savings, you know, build a emergency fund. It was a lot of you that indicated to me that you had either 1 month or no months of emergency fund on hand, right? If the pandemic has illustrated anything, it's the importance of an emergency fund, right? So I'm looking to, build that emergency fund first, maximize my retirement, maximize health savings accounts if I have access to things like that. Paying down other debt, right? There was a lot of you that indicated that you had, auto loans or medical debt or private loans. I'm looking to pay those other loans that do cost me something now before I make an extra payment to a loan that isn't costing me anything, right? And if I'm working towards forgiveness, then there's zero reason to make a payment right now, right? Because the time counts towards forgiveness. I'm not getting charged anything additional, and I don't have a payment due, right? So there's very little reason to make a payment during the suspension period. Now, if your debt, and we're going to talk about debt to income ratio in a little bit too, if your debt to income ratio is less than 1, meaning that your income exceeds your debt, then this can be a good time to gain some ground on your student loans, because you're probably going to pay it to 0 before you would hit forgiveness, right? But even then, it doesn't make sense to make the payments now necessarily, right? What I would do instead is take that amount that I was, thinking about paying towards my student loans, and I would put it in some kind of interest-bearing account and wait until payment restarts again and make that payment right before it starts, right? There's not going to be any benefit to you making it now versus the day before repayment starts again, because there's no interest accruing, right? As long as you get that payment to hit, the principal before the payment restarts again, it would be the same as if you made the payments consistently between now and then, right? And we don't know when repayment's going to restart. So it really, you can do a lot better things with that money than paying it towards your student loans now when there's no payment, no interest, and you're potentially getting credit towards forgiveness. But we'll talk a little bit more about that, I'm sure, before we get to the end, because I did see a lot of you were making payments during this time frame, and many of you were making payments above what your minimum requires anyway, which we need to talk about when it comes to income-driven repayment. Right. So this is what you showed when you talked about, or when you told me the repayment options that you're using. Right. So I saw, more than a third of you indicated IVR. Again, just want to double check, just because my experience shows that most people say IVR, but they may actually be using a different plan. Right. So upload those files. Make sure you know exactly which income-driven repayment plan you're using. This is what makes me think that, right? Based on your graduation years, there's still a surprising number of you that I think probably qualify for pay-as-you-earn, but might be using IBR, or the opposite, right? That you're actually using pay-as-you-earn, but you just call it IBR. And that's fine, right? There's nothing wrong with that. That's, we can clean that up. But if you're using IBR and you qualify for pay-as-you-earn, you may want to switch, right? Because again, pay-as-you-earn, generally speaking, is one of the more beneficial repayment options of the income-driven suite. Revised pay-as-you-earn, I did see several of you that were using that, and you didn't qualify for pay-as-you-earn, right? That's kind of like my situation. So this would be kind of the next best option for most of us, unless you're married, right? Then we may fall back into IBR, right? But we'll talk about that later. So here's some people using the standard tenure, extended graduated. I can't come up with a very good reason to justify one of these plans. So double check that. Double check your payment that you're making against what your income requires you to pay under an income-driven repayment plan, and let's see which one's greater, right? So we're going to get into how to do that, right? And then you want to see, and because some of you mentioned that, you've got $1,200, $1,400, $1,500 payments towards your student loans, and they're crushing you, right? I suspect that you might be using one of these types of plans, right? And if it's not a function of your income, it may be more than you actually have to pay, right? And we want to see if we can get that payment lower and get it pegged to your income so it can provide some relief. But those extended graduated plans, unless they end up with a lower minimum monthly payment than your income requires, they're usually not that beneficial. And even if they do, right, you'll probably want to pay, you can stay in that plan, but you'll probably want to pay something closer to what your income would require you to pay under an income-driven repayment plan, so you don't end up paying a boatload of interest and spend more time in repayment than you have to.
We have a couple more questions.
Yeah, sure.
Okay, so one is, I've paid extra towards my loans during the pandemic to pay down my unpaid interest, $80,000. Since I thought that never goes away, even if I hit forgiveness, is this correct?
Yeah, so your unpaid interest gets forgiven with the rest of your balance, right? And we're going to talk about that when we get to forgiveness. So yeah, and you actually can, right? Now there are provisions in the COVID legislation where you can request that back. So if you made payments during this pandemic relief period when you were not required to make a payment, you can actually request that money back. And it may be a really good idea for you to do so. If you have $80,000 of unpaid interest, my guess is you have a pretty high principal balance, right? And paying your unpaid interest during this pandemic period means you're probably still going to hit forgiveness, right? You might have a little bit less forgiven, but you're going to end up paying way more than you have to, right? So if you're ultimately, and we're kind of jumping ahead here, but ultimately, when you're using income-driven repayment, if you're projected to hit forgiveness and pay the tax, the strategy is to pay the minimum that is required by the plans and your income and plan for the tax. That will save you the most money, right? So if you work back from there, we know that we don't have to pay anything now. I'm not accruing any interest, but I am still logging credit towards forgiveness. That will save me more money in the long run by not making a payment and working on saving towards forgiveness rather than making a payment towards the unpaid interest. Right. And that's really the problem with the unpaid interest. Like the big negative of the unpaid interest is that you can't leapfrog that unpaid interest and pay down the principal until the unpaid interest is gone. Right. That's just how federal student loans are structured. Right. Any payments that go towards student loans first have to go towards interest before they can go towards principal. Right. But that's another reason why it's not beneficial to make additional payments during this pandemic relief or in general if you're going to end up hitting forgiveness, because you just end up voluntarily paying more than you have to towards your student loans.
Okay, the next question is, if you're on a time-driven plan, I'm on the 25-year one, will the time pause during this forbearance, or will the monthly payment change increase once the forbearance is over?
Yeah, so that's a great question. So that the time, just the payment and the interest pauses. So if you're using a time-driven plan during the pandemic relief period, it's like you're in suspended animation. So if you made 5 years of payments before you hit the pandemic relief and you were on a 25-year time-driven plan, once the pandemic relief period ends, you'll have another 20 years of payments to make at the same monthly payment amount. It's like that time just never happened, right? So if you continue on in that time-driven plan, then you'll have another, like I illustrated. I mean, you'll have the same amount of time remaining as you did prior to the suspension starting, right? So there's no penalty, right? But there's no time benefit either, right? For those of us that are using income-driven repayment, we're also receiving a time benefit as part of this suspension period. Okay, so let's talk about refinance. A lot of you had questions about refinancing. So when it comes to federal student loans, and particularly the kind of balances that we see veterinarians graduate vet school with, just getting a lower interest rate does not always mean you're going to pay less per month, nor will you necessarily pay less in total. Sometimes you might, but it really depends on how much we're talking about. But this is an easy exercise to actually go through, and this is one of the calculators that I grew up kind of on the edge of the internet, right when it was kind of coming out. Bankrate has been around almost as long as the internet's been around, so they're kind of like the first ones that started doing all of this type of stuff. The newer version of this is essentially NerdWallet or some of those other blogs that are out there, but you can find a bazillion of these loan calculators out on the internet, right? So time-driven calculators are a dime a dozen, right? You can do these on Excel and Google Sheets, or you can just pull up whatever your favorite one is on the internet, right? So if we take kind of one of the examples, let's see, this person has $247,000 of student debt. and their interest rate on their federal student loans is probably um, probably closer to like 6%, right? So if you're going to refinance, right, that's what a refinance is, right? They're gonna pay off your loans with the Department of Education, and ideally you're going to qualify for a lower interest rate. Otherwise, there's really no reason at all to do it. Um, but let's say maybe you can get let's say we can cut it in half, right? So if we calculate this, this is over 20 years. Let's say you can refinance it for 3% over 20 years, which would be really hard to do actually. It's going to be a $1,400 a month payment. Let's say that we want to pay it back faster, right? So the average amount of time that you all told me was a reasonable amount of time to be in repayment is 15 years, right? So the sooner that you pay off your student loans, the more you have to pay, right? If you want to pay them off in a shorter period of time, you have to pay a higher amount, right? That's just how time-driven repayment works, right? So if I want to pay this balance off in 15 years, I'm going to have to pay $1,700. If I want to pay it off in 10 years, I got to pay $2,400, right? The sooner that we want to pay it off, the higher the monthly payment is, which means now we're really starting to cut into our budget, right? We may not have $2,400 a month in our budget without pulling away from some of those other essential wellness items like saving for retirement or buying a home or starting a family, right? All of those other things that you generally want to do simultaneously, right? This is very difficult to do if you're trying to pay your loans off in a shorter period of time, right? Some of you, want to be really aggressive. I want to have them gone. So I think somebody told me I want to have them gone in 6 years from now. Now they may not have the same balance, but just to illustrate this point, the sooner you want to pay that to zero, the more you're going to have to pay. And that's going to be very difficult to do. Now we have to compare something like this to what our income requires us to pay, right? That's the value of these loan calculators. Not only will they tell you how much you'll pay plus the interest, right? So if I had $247,000, I paid it at 3% over 10 years, I'm going to pay about $39,000 of interest between now and in that 10-year time frame, right? So now I want to take that same these numbers and compare it to what does my income require me to pay based on what I'm earning now and what my family size is, using a plan like Pay or Repay. What is the difference in the monthly payment? And then what is the difference in the total cost I would pay long term? Right, so that's kind of the cost benefit analysis that we're working towards doing these physical exam and diagnostics on our student loans. Okay, so which plan should you use? This is the feature table that I was talking about. So all of these income-driven repayment plans have little feature differences. But the major theme is that you're going to pay a percentage of your income, right? So we started off with the ICR a while back, 1994, 20% of your discretionary income. We've since in the the first version of IBR, 15%, and now the newer versions of these plans have us down to about 10% of discretionary income. The current administration has proposed adding an additional income-driven repayment plan that might get us down to 5% of our discretionary income. Right now, whether or not that would be open to existing borrowers, it remains to be seen, and we don't have a lot of details on that, or whether it even happens, who knows, but that's what's being floated around there now. You can see the different loan types here that are eligible. If you have some of those older FFEL type loans, you can still use IBR, but all of the newer plans are for direct loans only, right? So you may want to consider a direct consolidation loan if you have a whole bunch of FFEL loans. There are ways to do that where you can get them into the direct loan program and then maybe qualify for Repay. You still wouldn't qualify for Pay or IBR, the second version, but you might qualify for Repay, which would get you to 10% of your discretionary income. There are different maximum repayment periods, right? So how long are you in repayment? Depends on the repayment plan that you choose. So the income-driven repayment plans have a very defined period of time, right? You're not going to be in repayment forever. You don't pay based on your income forever. It's actually written in the contract that if I use a plan like IBR, the first version, or a plan like Repay, the maximum amount of time I can be in repayment is 25 years, right? So the person who asked the question about switching from Repay to Pay in year 19, that would be because Pay as you earn has a shorter time frame, right? So, and the reason why you would consider switching from Repay to Pay is because of what's in this row is a 50% unpaid interest subsidy. Now, when we're in normal times, and it's been a while since we've been in normal times, right? If you're making payments and you're not covering the interest, the remaining interest goes into that unpaid interest bucket, right? But if you're using a plan like Revise Pay As You Earn, if you're not covering the interest, so if I'm accruing $1,000 a month of interest and I'm paying $500 per month payment, I'm falling short by $500 per month. If I'm using Repay, the government actually pays an additional $250 towards my loans, covering half of that unpaid interest, right? But the trade-off for that is I have to be in repayment longer. So the idea would be that I would use a plan like Repay for 19 years and switch over to Pay the year before I'm due to hit forgiveness so I could benefit from the unpaid interest subsidy in the shorter time frame of Pay. But every time I've run that analysis, you still end up paying more than if you would have stayed in Pay from the beginning and just planned for the forgiveness for the 20 years, right? And, theoretically that's possible, right? But we'll see what happens when people start actually applying for forgiveness and whether somebody tries to, find some way to stop that sort of thing. But technically, you should be allowed to switch between plans like that, with the penalty being the capitalization of that unpaid interest. Okay, so that's a little bit of a tangent there. But really, just the maximum repayment period is what you really want to focus on here. Is generally the fewer years that you're in repayment, the less you're going to pay, right? That's what makes Pay As You Earn more beneficial. One of the other things that makes Pay As You Earn more beneficial is this ability to separate your income from your spouse when and if you're married, right? So what income-driven repayment has done has created a kind of competing incentive structure in the tax code. And for eons, we've incentivized people to get married, have kids. We give you tax breaks for that in this country. The income-driven repayment plans actually disincentivize you to get married, but still incentivize you to have kids, right? So that we have some misalignment there, right? And sometimes it can make sense if you have a veterinary sized student debt balance and you're married and your spouse doesn't have any student debt or doesn't have much student debt, or your spouse earns as much or more than you do, then not having their income included in the calculation can be extremely beneficial from a student loan repayment standpoint. So very often we can see a dynamic where it makes sense for you to choose an income-driven repayment plan, in this case, Pay or IBR, that allows you to separate your income from your spouse by filing your taxes separately. Repay doesn't allow you to do that. I mean, you can still file your taxes separately if you want to, but there's generally not very good incentives to do so. But Repay doesn't care, right? If they ask you if you're married and you say yes, even if you file your taxes separately, they want to know what your spouse's income is in order to calculate your Repay monthly payment, right? So there are side effects of Repay that either you have to decide to maybe not get married, or you're just going to have to be comfortable with counting your spouse's income in that calculation, which may mean you end up paying a little bit more towards your student loans, right? But still hitting forgiveness. So this is where it starts to get complicated. And all of these things are actually built. All of these algorithms are built into, or these features are built into the VIN Foundation Student Loan Repayment Simulator. So you can cost compare the different scenarios based on your specifics and see which one comes out more financially beneficial for you. What we don't do in the simulator, we can't really estimate your tax costs, right? So you're going to have to work with an accountant there to find out how much is it going to cost you to file your taxes separately versus jointly, and then compare how much you might save in student loan repayment costs by excluding your spouse's income, and then decide which one's going to work best for you. I'll show you that in the simulator a little bit later. Okay, so what does your income require you to pay, right? So this is where we're going to do a little bit of math check here to see if you can experience some savings, right? So many of you are very aware of how much you are paying towards your student loans, either now because you're still making payments, or before the pandemic relief started, you knew what that payment was before. But let's do some math to see what your income actually requires you to pay. On average, you told me, for those of you that submitted your student debt and income signalment form, you're earning about $105,000 per year, right? So we can use that as our baseline. So your income determines the payment under income-driven repayment. And the formula they use is called discretionary income, right? So your discretionary income is very well defined, and they're going to take a percentage of your discretionary income. People get confused by this, right? Because discretionary income is actually used by financial planners too, and it means a whole different thing. But discretionary income in this context, in the federal student loan repayment context, has this exact formula, right? So they're going to take your taxable income, subtract off 150% of the federal poverty guidelines, which factor in your family size and your state of residence, and that's your discretionary income, right? So let's say that you have $105,000 taxable income, your family size is 3, you're going to pull this 21,960, right? So this is the federal poverty guideline for a family size of 3 in the lower 48 states. This was just updated, I think, last week or the week before. Every year they get adjusted roughly by inflation. This is used for a whole host of things in the government universe. This is just one of them, right? So calculating your income-driven monthly payment. So if I have $105,000 of taxable income, I subtract off this 1.5 times this family size of 3 allowance, my discretionary income is $72,060. Right, so I'm going to take, in this case, if I'm going to use pay or repay, I'm going to take 10% of that and divide it by 12. That's going to give me a monthly payment, right? So pay or repay, my income at $105,000 a year requires me to pay $601 per month, right? So compare that against what you're paying now, right? So for those of you that said I'm paying $1,300, $1,400, $1,500 a month and it's crushing me, if you have this average income, your income requires you to pay $601 per month if you're using repay, presuming you don't qualify for pay. Even if you didn't qualify for repay because you had FFEL loans, you could still use the old version of IBR. That requires you to pay $901 per month, right? It's 15% of that discretionary income, right? So here now we have some numbers we can work with. Look, let's come back here and look at our bank rate calculator, right? If I had $250,000 of student loans and I wanted to pay them off in 10 years, I'm paying $2,400 a month. Even if I refinanced it at 3%, my income requires me to pay $600, right? I can do a lot better things with $1,700 per month in my budget than just putting it towards my student loans, right? That's the key here, right? Is using the knowledge of what these options are and what they require you to pay can really help you free up money in your budget and relieve that stress that you feel like you can't gain any ground because you can't save for retirement, or you can't buy the home that you want, or you can't start a practice, or whatever the barrier is, right? Usually you can free up some pretty significant money in that budget just by choosing how you pay back your student loans. So is there a magic number you should pay? I think there is. The magic number is a percentage of your discretionary income, right? I think this is a great measure whether you're using an income-driven repayment plan or not, right? So let's say that I'm using a 25-year graduated plan, and maybe my monthly payment is I don't know, something less than this. Maybe it's $500 a month. I might choose to pay $600 using the income-driven plans as kind of my guide, right? For how much 10% of my discretionary income is, right? And I'll pay that loan to zero in a shorter amount of time and save some money on the interest on that time-driven plan, right? So you can use these two as a gauge or to give you a hint in terms of how much you should pay towards your student loans if your current monthly payment is actually less than what your income would require you to pay. But I think this magic number, this is a pretty good gauge. This 10% of your discretionary income, I think, is an excellent gauge for how much you should be paying towards your student loans. And if you're paying more than that, you don't have to, right? You can pay less than that, presuming you qualify for one of these plans. Worst case scenario, you're paying the IBR amount, which is 15% of your discretionary income. But either way, the fact that it's tied to a percentage of your income and not just some random amount that might not have any tie to what you're earning, I think is better than trying to use a time-driven amount on a significant amount of debt, like a veterinary education sized student loan. So how much is your income required to pay? Is it more or less than what you're paying now, right? So that's what you're going to work through. And then we have to talk about this taxable income, right? This $105,000 average that you all provided to me, I'm guessing is your gross income, right? This discretionary income formula asks for your taxable income, right? And for those of you who have started saving for retirement, or you've made some health savings account contributions, or you're paying health insurance premiums, you're going to know that those things are subtracted off of your gross income, right? So there's incentives there for you to maximize your retirement savings, right? To maximize those health savings accounts, to make sure you're paying for your health insurance, right? That will lower your gross income to get to your taxable income, which will lower the amount of taxes you're paying to the IRS, but it'll also lower your monthly student loan payment, right? So these things start to stack on top of each other, right, and work in your favor. All right, so what if you're married, right? So if your spouse has student loans, that's going to, that factors in the equation. How did you file your most recent tax return? That's the question that's on the income-driven repayment application. How did you file your most recent tax return, right? So if you filed jointly, or you haven't had a chance to file yet because you just got married, once you indicate that you're married, they're going to ask you for your spouse's income, but it's for the calculation of the income-driven monthly payment, right? A lot of people, I get a lot of questions from people that are like, oh, they want my spouse's income. Does that mean my spouse is now on the hook for my student loans? It does not, right? It's just the rules of how the plans are written. If you're married and you filed a joint tax return, right, or you're using a plan like Repay, you're required to provide your spouse's income as part of the calculation. That's just how the rules are written. It doesn't make them responsible for your student loans. If they also have student loans and you're filing jointly, or you're using a plan like Repay, their balance will be factored into that equation as well, right? So basically they take your combined incomes, they calculate a household monthly payment, and then they distribute that payment proportionately to both of your loans, right? So whoever has the higher share of the balance is going to get a higher share of the payment, right? So if you've got 75% of the household student debt, 75% of the payment is going to go towards your student loans, right? The other 25% will go towards your spouses. So this can actually set up a scenario where if you're married, if your spouse has student debt, but they have a significantly lower amount than you do, and some of you submitted that exact scenario, right? Some of you had, $250,000 of student debt and your spouse had $35,000 of student debt, right? They can get a benefit from income-driven payment too, right? So you can free up money in your budget that way, because the majority of the payment is going to go towards your student loans, which means they're going to be a tiny, tiny fraction of the payment goes towards their student loans, right? So that's another trick you can use when you both have student debt and you're both eligible for income-driven repayment. Filing separately, again, I kind of covered this. It can make sense. You're probably going to pay more in taxes, but you're also likely to save a significant amount in monthly student loan payments, right? So you have to figure out which one's going to be more valuable to you, right? Which one puts more money in your pocket. You might have to work with your accountant to do that. So let's do this. This is an example somebody submitted. So they had a $100,000 income. Their spouse made about $70,000, right? So this is an example of what this might look like, right? So your discretionary income is obviously higher, right? So the same family size of 3 we'll use. I kept the pay as you earn and IBR the same, assuming that you would file separately just because you can, right? But you can see the difference here. If I kept my spouse's income in the calculation, Repay requires me to pay more than $500, nearly $600 a month more, right? So this is what I'm talking about here. So there could be a $500 plus difference per month just by filing your taxes separately. 500 times 12 is $6,000, right? Is it going to cost you more than $6,000 to file your taxes separately? Probably not, right? Sometimes it may, right? And in that case, then you'll choose to pay the more and file your taxes jointly. But if you're going to save more by paying less, filing your taxes separately, acknowledging that you're going to pay more in taxes, then you're going to do that anyway, right? Because you're going to save more overall by separating your income from your spouse. So that's the cost benefit analysis that you're going to want to do. Okay, so length of repayment, we kind of talked about this, right? So income driven repayment, maximum repayment period for the newer versions of the plans are 20 years. Repay and IBR, the older version, have 25-year maximums, right? So if you still have a balance remaining when you hit that maximum repayment period, that's what triggers forgiveness. So you only experience forgiveness if you have something left to forgive, right? So this doesn't mean that you'll automatically have a tax, right? It just means that you'll be taxed on whatever is remaining if you reach this maximum repayment period. It could be that you use an income-driven repayment plan and your income climbs high enough, fast enough that you could pay the balance to zero before you hit forgiveness, right? Which is another reason why I like income-driven repayment. It's tied to my income. My income will either pay my balance to zero before I hit forgiveness or it won't. Either one is fine, right? But if it won't, then I have to make sure that I plan for forgiveness. I got a question here. If you file taxes separately and say both of you and your spouse have student loans on IBR, do the loan servicers take into account that your spouse has student loans for the monthly payment calculation? Yes, they do. So if you both have student loans and you're filing your taxes jointly, wait, hold on a second. If you file your taxes separately and you're using IBR, then no, they will not. So if you both have student loans and you still file your taxes separately, now you really want to, sometimes every once in a while, like, 1 out of the 100 that I do for married people, I'll see that work out like that, where it makes sense for them if they both have student loans to file separately. That's not very common, right? So you may want to look at potentially filing jointly and moving over to Repay, right? If you're using IBR, both of you. So that could be a better fit. That way you would get the tax benefits and likely a lower monthly payment because Repay is a third less than IBR. But that would be something that we want to look at, investigate. But to answer your question, if you both have student debt and you file your taxes separately and you choose not to include your spouse's income in that calculation, then they will not factor in their debt balance in that proportional assignment.
There's another question too, Tony.
Yep.
If you are on payee and file separate from your spouse, is your household size 1 or 2 for calculating HHS poverty guidelines?
Yeah, great question. So if your family size, if you're married, regardless of how you file your taxes, always includes you and your spouse. So even if you file your taxes separately from your spouse, the family size there is at least 2. Family size is also different than dependents, right? So family size will count any child that you expect to be born in the year that you're going to be making student loan payments, right? So if you're pregnant, your family size would be you, your spouse, plus your unborn child, right? And any other children or even adults that live under your roof that you provide more than 50% of the living expenses for. So that's who counts in your family size for student loan payment purposes. Okay, so this was some of the things that you all told me, right? Hopefully before I die, that's one of my favorite ones. I want to pay them off as fast as possible. Am I doomed to pay my loans off until I'm 50? Maybe. I mean, I want to be in my 50s when I hit forgiveness. I'm not too worried about that again, right? Because it's a percent. I'm using income-driven repayment. I know the payment is always going to be a manageable percentage of my income, which means I have the rest of my income to do all the other things that I want with, right? So I don't worry too much about this. They'll be gone when they're gone, right? And that's the nice thing about my student loans is I don't have to worry about trying to get rid of them before they have to be gone, right? Either my income will grow high enough that the payment will be high enough that pays them off sooner, or I'll hit forgiveness, right? And I'm prepared for that if we're going to hit forgiveness. Definitely before you die, most likely, right? Unless you're going to die in this 20 or 25-year period, right? But, statistics tells us that that's probably not going to be the case. So you will not be in repayment forever, right? Worst case scenario here is 25 years. Okay, I need to little faster here. So how do we use some of this knowledge to know which repayment strategy we should be using? So after running thousands and thousands of simulations for our colleagues, some themes emerge. And the biggest performance indicator, if you will, KPI, key performance indicator, for how you should approach paying back your student loans is your student debt to income ratio. And your student debt to income ratio is your student debt balance divided by your income, right? So debt divided by income gives you your debt to income ratio. If you're less than 1, then your payment that would be generated based on your income is going to be very similar to a standard 10-year plan payment, right? So that's when you want to use something like a standard 10-year plan payment or a more traditional repayment structure like a private loan refinance. Repay actually works really well in these situations too. You'll probably end up paying your loans to zero faster than 10 years if your debt to income ratio is less than 1 using a plan like Repay. But if your debt to income ratio is 2 or higher, mathematically, your most beneficial repayment strategy is to use a plan like pay as you earn, revised pay as you earn, IBR, pay the minimum, and plan for the forgiveness. It is highly likely in this case that you're going to hit forgiveness, right? So pay the minimum, plan for the forgiveness.
A question just came up, Tony. Sorry, they're coming up at this moment, but I think it's helpful. So do you think it's worth it to request the money back if I've been paying since the CARES Act to put towards the tax payment of what is forgiven?
I do. And I think that is a rare do-over, right? That,
and where do they even go to start to do that?
You would go through your loan servicer, right? And you can, and if I'll come back over here. So if you go back to the federal student aid website, studentaid.gov, they've got a great FAQ, right? And it just announced COVID emergency relief flexibilities extend through the September 30th, right? So they've been really good at keeping this up to date. But in here, it talks about retrieving those payments. So loan payment suspension. I just saw this the other day. I know I wouldn't be able to find it. It's in here. So you can request those payments that you've made during the suspension period back, right? So any payment that you've made since March 13th of 2020, when the CARES Act took effect, technically they should refund back to you, right? And there is some language in here that talks about that, and I would refer to this language. Hey, I saw on the federal student aid website, it says that I can request these payments back. Can you please provide them? Right. And I don't know what the logistics are or how they're going to do that, if they're going to refund it back to your bank account or if they're going to send you a check. But you are eligible to request them. So
I found it on the site. It says, if I made a payment after the president signed the CARES Act on March 27th, 2020, can I receive a refund? If you search the page for refund, and then it says, yes, any payment you made during the suspension of payments beginning March 13th, 2020 can be refunded. Contact your loan servicer to request that your payment be refunded.
There you go. Contact your loan servicer to request that your payment be refunded. So yeah, if you anticipate hitting forgiveness, right, and particularly if you're not feeling good about your forgiveness savings plan, or you want to redirect those funds to something like retirement or emergency fund or any of those other reasons, I would definitely request that money back, right, because you can, right? And again, everything about this CARES Act is super ridiculously beneficial for those of us who are in repayment, and rightfully so, right? I mean, this is a once in 100-year event we're living through. But if you're still have a job and have income and everything, I mean, these are some really beneficial provisions that you can take advantage of to make up some ground on some of the other areas of your financial wellness.
Okay, another question came in about forgiveness. Will we have to pay the taxes on forgiveness in full once it happens, or can we re-enter another repayment plan? Will this cycle ever end? I worry because that's when kids may be entering college and whatnot.
Yes, the cycle will end. You have to make it end, right? So technically speaking, yes, when your loans are forgiven. So we're in tax filing season now, right, for the 2020 calendar year, and our taxes are due by April 15th. If I had my loan balance forgiven in the year 2020, I would have to pay the tax on that by April 15th of 2021, or set up some kind of repayment plan with the IRS. But setting up a repayment plan with the IRS is going to incur penalties, interest, not only on the tax amount, but interest on the penalties until I pay that in full. You do not want to put yourself in a position to have to take out a loan or set up a payment plan with the IRS, right? For most of us, we still have 10 years or more before we reach forgiveness, right? Start working on a forgiveness plan, right? Use that time to your advantage. Start stashing away some money based on how much you think is going to be forgiven, so you don't have to set up a repayment plan with the IRS, right? So use that time to your advantage and budget appropriately, and hopefully you won't have to put yourself in that position. All right, so treatment plans. So what is the best way to repay your student loans? So the best is not always the fastest, and the fastest is not always the cheapest, right? So this is a phenomenon that's unique to federal student loans, right? You have the ability to pay based on your income using those maximum repayment periods, and then understanding that forgiveness is associated with it and try to estimate what that might be for you. There are also other benefits to doing this, right? So the best strategy, when I say best, right, everybody wants to know the best. I mean, it's kind of subjective, right? But if we try to define it, the best strategy allows me to reduce the risk to myself and my family, maximize my cash flow, and reduce my total repayment costs. So I may not get all three of these, right? But I'm shooting at least for those first two, right? I may, by paying based on my income, I may end up paying a little bit more than if I would say were to pay over a standard 10-year plan. But that's okay for me, right? Because I know that it reduces the risk to myself and my family. If I should get hit by a bus tomorrow, my wife doesn't have to worry about my student loans. They go away with me, right? There's some huge piece in insurance built in there. There's never a scenario where my wife is going to be responsible for my student loans, nor I responsible for hers, right? That's written in that master promissory note of those federal student loans. Maximizing my monthly cash flow. I find that veterinarians really struggle with how much they should be paying towards their student loans, which means they inevitably end up throwing more money than they have to towards them. The income-driven repayment plans tell me how much I need to pay. 10% of my discretionary income, right? That gives me the other 90% to decide how I should spend it, right? I don't need to pay any more towards my student loans. That's a good enough number. If I hit forgiveness, so be it. If not, so be it, right? At least I know that I have the additional cash flow flexibility to work on other areas of my financial wellness. And then ideally, and this, you'll see this with the debt to income ratios 2 or higher, you will also end up reducing your total repayment costs by doing that way. So let's look at those a little bit more closely, right? So debt puts you at risk, and there are definitely consequences if you can't make the minimum payments, right? But the nice thing about your federal student loans is if you ever find yourself in a situation where your income is decreased, right, for any reason, whether you're moving, you're between jobs, maybe you're, on maternity leave, whatever, you can have your payment lowered, right? It can be lowered to whatever your current income is, right? So there's not a situation where I'm going to end up there won't be a case where I can't make payments on my student loans, right? If I don't have any income, my payment's going to be zero, right? So you can have a $0 payment just like we do now with the pandemic relief, even if your income is zero. Private student loans are less flexible, right? They have very limited deferment forbearance provisions. A lot of them require a cosigner, right? Here, this is perfect illustration of that. Major concern that my non-federal loan used to be federal and the private loans will be held against my family. That's where you really have to pull out that contract you signed. In many cases, in order to get the lowest interest rate that you can on a pretty high balance on a private refinance, they're going to want to have a cosigner, whether that's your spouse or your parents or some other family member. That's what reduces the risk to the bank, right? Because if something should happen to you, then they can lean on that other person who co-signed to pay back that loan. And then in exchange, they'll give you a lower interest rate maybe for that, or more favorable terms, right? But that puts that other person at risk. That doesn't exist with your federal student loans, right? And then as we illustrated before, you could still end up paying more per month and more in total, even if you're able to cut your interest rate in half, right? Because of the way the income-driven plans work and that forgiveness that's at the end, if you hit it. When it comes to maximizing your cash flow, this is probably the most important one, right? Because this is what I find most, early career veterinarians struggle with the most, is navigating all of those other financial wellness items that really benefit you the most the soonest you can start them, right? So the sooner you can get going on your retirement savings, your emergency fund, your HSAs, buying a home, all of those things are going to build wealth long term over time. If you're paying more than you have to towards your student loans, it postpones your ability to get to those things, and it shortchanges your future, right? So when you say I'm so far behind with my 401k and owning a home, right? Consider paying your student loans based on your income and using that cash flow flexibility. That's what I mean, is having having more money in your monthly budget to do these sorts of things, right? And you can then stack those incentives where you'll pay less in taxes, you'll pay less towards your student loans, and you'll have more in your retirement fund or more in your HSA, right? Or you'll have that home sooner, right? Those are how you're going to get to those things. So this is what, this was probably the one that was the most eye-opening for this group, right? Do you make payments above the minimum monthly payments on your student loans? More than half of you said yes. Again, one of these days I'm gonna write this book of 101 things you can do with your money besides putting it towards your student loans, and you'll be better for it, right? I have way outgrown my student debt balance by maximizing my retirement over the last 8 years, right? And I'm still, my student loans are still going to be gone, right? We were able to buy a home several years ago with 20% down and have more equity in our home than we have in student loans, right? These are things that are going to way outgrow your student debt quickly, right? And then set you up long term in better shape, right? You don't have to pay more than your income requires towards your student loans. Right, but I do find that many veterinarians kind of have this self-imposed barrier that they have to get rid of that student debt before they do anything else, right? And unfortunately, sometimes that's, for many of us, that would take a lot of time, and it's not going to leave us time to do those other things appropriately, right? If you start saving for retirement when you hit 50, your retirement is not going to look very robust, right? You're going to have to start that sooner rather than later. So income-driven repayment, again, if your income goes up, your payment goes up. If your income goes down, your payment goes down. It's always the same percentage of your discretionary income, right? So it's not a bad thing if it goes up. It means you're earning more money. If it goes down, it means you're not earning as much money as you were before, right? That's okay, right? It's still the same percentage of your income. All right, so let me skip ahead here because I think I'm falling way behind here. I'll show you guys the effective interest rate in another way. Okay, so the side effects. There's side effects that are associated with either way you choose to pay back your student loans. So with income-driven repayment, the big ones are what's called negative amortization, right? That's how you end up making payments that don't cover the interest and the loan balance actually grows. That's allowed, right? But you're still considered to be in good standing as long as you're making that minimum monthly payment. Capitalization, we've alluded to a few times. We're going to talk about that in more detail. And then just watching that loan balance grow or having this feeling that your balance never decreases. I mean, that's not unique to income-driven repayment. I see that with time-driven repayment too. But some of the side effects associated with time-driven repayment are higher monthly payments. So they occupy a bigger chunk of your monthly budget. Sometimes, especially with the private loans, they require co-signers. They have limited relief provisions. We're seeing that with the pandemic relief now. Some of the private lenders have tried to somewhat mimic the relief, but it's not nearly as robust as the relief that we've received with our federal student loans, right? So you just don't get that kind of break and you can still lead to that, what I call traumatic statement syndrome, which we'll also talk about. So unpaid interest, if you're making payments that are less than the accrued interest each month, again, when we're outside of a pandemic and we're actually accruing interest on our loans, you can have unpaid interest. If you're using an income-driven repayment plan, as long as you're still paying the minimum monthly payment that's due, you're still considered to be current and in good standing on your loans, right? That will actually reflect positively on your credit report and your credit score, even though your loan balance is growing, right? So that's one of those weird benefits of income-driven repayment. You're not charged interest on that additional interest unless it capitalizes, right? So you want to make sure that you avoid that capitalization. In time-driven repayment, they don't even allow unpaid interest, right? Or if they do, it's very short-lived. It's kind of like a credit card. It gets added to your principal at the next billing cycle, right? And if you have persistent unpaid interest, that's actually the definition of default. That's what defaulting on a loan means, is that you're not paying the interest. That has some pretty stiff consequences for a time-driven loan, right? So that will definitely negatively impact your credit and increase your cost long-term. So it is important to know the difference there, right? So time driven, just because, that's the definition of default. In the income driven repayment world, in the federal student loans, they actually allow this, right? And they consider that to be in good standing. I can't explain it, right? But that's how the rules and the law is written. So you can take advantage of it, or you can choose to not take advantage of it. Another point we have to make here is really one that I see a lot of people struggle with. They constantly tell me that I need to pay off my federal student loans because they're compounding. Your federal student loans do not compound. Again, that unpaid interest stays in that unpaid interest bucket unless you give it a reason to capitalize, right? And there are several instances where that can happen. So when you enter repayment, consolidation, switching repayment plans, which we've talked about, failing to submit your income-driven documentation on time. That's another trigger for capitalization. When they do take that interest and add it to the principal, that's when you start being charged interest on that interest again. But it's a one-time event, right? So it does not continually capitalize. So capitalization has a compounding effect, but it's not the same as compound interest. Another instance where this drives me bonkers is people tell me that, well, I shouldn't start saving for retirement because my student loan interest rate is 6%, and I probably can't get that kind of return on my retirement. So I should pay off my student loans first. Those are completely different things, right? Apples and oranges, right? Your retirement savings experience compound growth in your favor, right? So to assume or equate your interest rate on your student loans to the compound growth that your retirement savings can experience is completely wrong-headed, right? Again, I've demonstrated this with our own retirement funds. You will way outgrow your student loans by continuing to contribute to retirement and experience, 6, 7, 8, 10, 12, 13% growth. Way outgrow your student debt balance, which is accruing simple interest and not compounding over the period of repayment, right? So don't ever forego those retirement savings because you think you're doing yourself a favor because the interest rate on your student loans is too high, right? You're really kind of stealing away from that future growth. That future compound growth is actually going to accrue in your favor. Capitalization, one of the ways to avoid capitalization is to stay out of deferment and forbearance. Now, I'm not talking about the special forbearance that we're in now with the COVID-19, but after that, right? So I do see a lot of people who put their loans into deferment or forbearance either during maternity leave or because they're in between jobs or their income decreases for some reason or whatever. That is one of those triggers for capitalization, right? So they'll take that unpaid interest and they'll add it to your principal. So stay out of deferment. You can use income-driven repayment instead. If your income should decrease, you can submit to have your payment decreased. So there's no reason to use a deferment or forbearance. To avoid failing to renew your income-driven repayment documentation, set up a lot of reminders, right? Don't just rely on your loan servicer. They should provide you reminders, timely notification when your income documentation is due, but don't trust them, right? Set your own reminders and submit that documentation on time each year and make sure that they process it. Okay, so let's talk about forgiveness. So there's been a lot of questions about forgiveness. And, you know, a lot of you are kind of right on it, right? So yeah, if you have a balance at the end, so if you reach that maximum repayment period, it will be forgiven and treated as taxable income, right? So any remaining principal, unpaid interest will be counted in that forgiven balance. You'll receive a 1099-C in the mail that year. So back to my illustration, if that were to happen for me in the year 2020, I would have already received my 1099-C that said the Department of Education canceled, that's what the C stands for, canceled X amount of dollars on your behalf. You have to report that as income when you file your tax return that year. If you live in a state that has income taxes, you'll also have to pay state income taxes on that, right? So make sure you're factoring that in. If you live in a high tax state like California, New Jersey, Illinois, some of those states have some pretty high income taxes. So you're going to have to make sure that you're accounting for that as well. You don't have to apply for this forgiveness, right? So it's not the same as public service loan forgiveness, which you have to apply and they have to grant it. This is strictly triggered by the number of payments that you've made. And once you reach the maximum number of payments, the remaining balance will be forgiven, right? And it only happens if you have a balance to forgive. So is it a tax bomb, right? Everybody calls it the tax bomb, or is it actually a discount, right? And this is where we have to turn to the loan repayment simulator to take a peek, right? So if we come back to some of the examples that we've been using, right? So let's take this person's student debt and send it over to the student loan repayment simulator. Now we're gonna have to make some assumptions here because I don't know what the interest rate is exactly, but we can work around that. And this is a 2011 graduate, right? So they've been using Repay, right? And I'm assuming they probably started in IBR before they switched over to Repay. I'll assume that their interest rate is 6%. Let's say that they've been using income-driven repayment for nearly, let's make it 9 years. If they started in IBR and switched to Repay, right, that would still count towards the payment. We do know that the COVID interest suspension is going to be extended through September, which is another 8 months from now, right? So we can extend that in the simulator. Let's assume that we've got our average amount of income here. You do have to make some guesses about what your income is going to be doing, but you guys have been working long enough now where you can probably have a pretty good idea of how much your income changes from year to year, right? You can assume a flat rate of growth, or you can change it from year to year. Inflation's running roughly around 2%. I mean, you can change it to whatever you think is appropriate, right? So we'll just kind of keep it
Somebody
simple.
just said, I believe that that's mine. I have a majority of loans at 6.8% and have a grad plus for 7.8%.
Okay. And if
then she said, I did switch from IBR to Repay a few years ago.
Okay.
My API with my spouse is 226.
Yeah, well, that's the problem there, right? We would need to we would need to separate some of that out. So that's great that this is. So if you have a few loans that are at 7.8, right? I would say that maybe your interest rate is 5, right? But you also get a 0.25% interest rate discount if you're using the auto pay feature. So somewhere in there is going to be reasonable, right? So if we assume that you have 105,000 and your spouse is the other part of that, right? We can do separately just to see what it looks like. Now you're making me do tough math here. I have no idea how to guess what your spouse's income increase is going to be, right? So these are just to illustrate what this might look like. Does your spouse have student debt? We would have to fill that in. If you have children now, if you have children in the future, all of that will play into your family size, right? If you're going to have something forgiven, you can change these things. If you've allocated some amount towards forgiveness, right? Maybe you've got $25,000 saved up already towards forgiveness. We can factor that into your forgiveness plan, right? All of these are just to help you see what your payment would be. So we're in Repay, right? But we know that even if you file your taxes separately, they're going to charge you they're going to count your spouse's income in that calculation, right? So this would be the monthly payment. In this case, it looks like you do still end up with an amount forgiven, right? So we would want to see in this, their 135,000 is forgiven in 16 years from now. That would result in about a $40,000 tax, right? If I factored in, let's say you had $25,000 on hand, essentially if that grew at 3%, you wouldn't have to save anymore, right? You're already set, right? But if I didn't have anything saved yet, I would have to allocate $165 per month, right? In order to have enough on hand to cover that tax that's projected here under Repay. And this is actually still pretty close to what the standard 10-year amount would be, right? But yet your monthly payment is half as much, right? So in this case, I would still make payments based on my income because it's going to free up that $1,500 a month for me to work with. And depending on whether or not I had a forgiven amount on hand, I think I have some notes here from this particular one. I'm not sure. So you would have to, if you have something saved, we'll factor that in for you, right? So if you don't, then you have to start saving more over that period of time. I'm starting to get them confused. I saw some of you had $5,000 saved. There was some person that told me that they had $27,000 saved. So you're going to have to work that in, right? So that will impact how much you have left to save for your forgiveness. And then how you save for it is also important there, right? So 3%, if you've got 16 years before you hit forgiveness, you can probably, put that in something that's a little bit more aggressive, and that will come down, right? Or if you want to just put it all in savings accounts, right, then you'll have to save more, right? Because you're going to earn some interest on what you're saving for forgiveness, but still paying this plus this, right, for my forgiveness plan is way less than paying this, right? And that's where that money comes from, the budget, right? So when, if you're worried about not being able to save for forgiveness, start breaking it up into chunks, right? $175 on top of what you're paying towards your student loans in this case is not a lot, right? But you can see that pay as you earn, if this person did qualify for pay as you earn, it would be a lot more, right? Because the forgiveness happens 5 years sooner, right? So that's one of the side effects of pay as you earn, is that you hit forgiveness sooner. You don't have as much time to plan for it. So you have to be a little bit more aggressive in planning for it. And this one allows us to separate our income from our spouse. So we're paying much less towards our student loans, which means we end up having a lot more forgiven, right? So these are the kind of the, this is what you're measuring, right? This is what you're going back and forth, trying to figure out, testing the differences between those different repayment options and using it to help you plan for forgiveness if you see that there's an amount to be forgiven here. I said I wanted to highlight this effective interest rate, right? So if this simulation came out how we inputted it in here, and you have $260,000 remaining, and you end up paying, in this case, $400,000 is the total cost of the loan, you essentially ended up paying $140,000 of interest over 16 years, ends up being an effective annualized interest rate over that 16-year period of 3.36%, right? So even if your stated interest rate up here is 6.5%, right? If this simulation ends up coming out exactly how we projected it, 16 years from now, you would have paid the equivalent of 3.36% of interest under this Repay scenario, right? Which is pretty damn good, right? So you really don't have to refinance your student loans to receive a lower interest rate if you're paying based on your income and you hit forgiveness, right? You'll end up paying a pretty low interest rate anyway, right? So again, compare this against any kind of refinance, and then you have to come up here and compare that against what they're going to require you to pay, right? You're not going to be able to refinance $260,000 of student loans and pay $1,600 a month, right? There's just not a scenario where that's going to happen, right? So these are the kind of pros and cons that you want to weigh with the simulator based on your particular situation.
Somebody just asked, do you have a good source for looking up our income tax rates state by state and federally?
Sure, the Google. I forget the name of the is it Tax Foundation? Taxfoundation.org, I think, has a pretty good handle on all of the state tax brackets as well as the federal income tax brackets. But you can just look up, federal income tax rates, state income tax rates.
NerdWallet, it looks like, has some.
Yeah, I just type in the state and the tax rates, and it'll tell you what the bring up a table for you. Here's the 2021 tax brackets. Yeah, Tax Foundation.
I just put in the chat the one from NerdWallet as well. There's also another question which said, she said, I graduated in 2013 on IBR, have loans from undergrad, so don't qualify for payee. I have 347 principal and 80K unpaid interest. Sounds like the recommendation is pay the minimums and wait for forgiveness. Is that right?
Absolutely, right? Again, chances are, so coming back to our key performance indicator of debt to income ratio, and until or unless you see your income reaching $430,000, right? Income-driven repayment is going to be your best repayment strategy moving forward, right? Because $430,000 of income would put you at a debt-to-income ratio of 1, right? But that is probably unlikely, right? There are veterinarians who are earning more than $400,000 a year, right? But that's not the norm, right? So, unless you see a pathway for you to earn that kind of income in a relatively short amount of time, and it maintains that level for the duration of repayment, then you're going to want to use income-driven repayment. Can you read again you graduated in 2013?
Yep, 2013 on IBR, have loans from undergrad, so don't qualify for payee. She has 347,000 principal and 80K unpaid interest.
Okay. And you're on Repay?
She said on IBR.
On IBR, okay.
Yeah.
So you might qualify for Repay, right? So let's say you've been using IBR for 7 years, right? I'll use the same income here. I don't know any of your marital status, so I'm going to leave that out, right? I don't know what your forgiveness savings plan is there, right? But this is what you would do, right? You would plug that information in. Ideally, you would upload your file into the My Student Loans page and just bring it over, right? But you can start from the simulator as well, but it'll be more accurate if you bring that information over from the My Student Loans page, right? If we look at the monthly payments under Pay or IBR, IBR is higher than Repay because Repay is 10% of your discretionary income. All right, so you said that you don't qualify for Pay, so we won't look at that one. But here we can compare IBR to Repay, and we can see that Repay, even with the capitalization of the $80,000 of interest, is quite a bit less expensive than IBR, right? So when I mentioned earlier that we take into account, right? So if you stayed in IBR, we'll keep your unpaid interest in the unpaid interest category, right? Because that's how the plan is scheduled to work. But if you switch repayment plans, we're going to take that unpaid interest and it's going to get added to your principal. So your principal in this case would be 427. So you're going to accrue a higher amount of interest, but you're going to pay a third of the amount per month you're still going to have the same amount of time before you reach forgiveness, but because you're paying less per month, your total minimum payments are less. You'll have more forgiven, a little bit more, right? In this case, you're going to have $578,000 forgiven. We have to come down here and figure that out. So I've got 18 years left if I haven't started saving, right? That means I got to allocate another $600 a month towards my forgiveness plan, or I have to try to be a little bit more aggressive, right? So if you treat your forgiveness plan like you do your retirement, right? It's a long term, right? We still have 18 years here, right? So I can, try to allocate those investments in something that's, exposed to the stock market and maybe is going to yield a higher return. Then I don't have to save as much, right? And $500,000 with the tax rates, right? I probably would bump this up to 35%, right? So if we go back to the question about the taxes, right? The top marginal tax bracket in the federal world right now is 37%, right? But you have to earn a lot of income before you get taxed at 37%. So your forgiveness might tip you over into that, right? But likely not, which is why we assume a lower tax rate on in the forgiveness planning module. The default is set to about 30%, which I think is an overestimate for pretty much everybody, right? But you can change this to whatever you want, right? So it's really going to depend on what those tax rates are 18 years from now in this case, right? And those tax brackets get adjusted by inflation as well. So even if you had $500,000 of income, it's probably going to fall in a middle tax bracket 20 years from now. So, that's part of the art of this, right? Is looking at tax brackets, taking your best guess of what they're going to do over time, paying attention to what your tax bracket is now, right? All of you have experience with filing your taxes, right? When you file your taxes, there's going to be an effective tax rate on there, which is essentially your average tax rate, right? Use that in here, because that's probably going to be what your tax rate is when you hit forgiveness. It might be a couple of percentage points higher, but it's not going to be astronomically higher, right? But coming back to, is this a tax bomb or is it a discount, right? It's kind of both, right? You do have to figure out how to navigate this amount forgiven, which is going to generate a tax bill, in this case of $200,000, right? But it's still a huge discount, right? In this case, this person has $427,000 of student debt balance remaining. And if this projection comes to fruition, they're going to pay $310,000 in total, which is less than they have remaining, right? So while you have to figure out how to pay the $200,000 in taxes, you can see here the effective rate is negative, right? And that's because they're paying less than what they have remaining in student loans right now by navigating forgiveness and the tax associated with it. This is what we commonly see with the higher balances, right? The higher your debt to income ratio is, the higher your student debt balance, the more likely it's going to be that you end up paying less than you actually owe now, right? Which is another reason why you have to pay really close attention to changes to the income-driven repayment plans or adding of new ones, or what tax rates are, so you can make sure that you navigate this and have enough on hand to pay that tax and don't have to write an IOU to the IRS.
So yeah, Tony, we have a few more questions here. Do you want to keep going and we'll do?
Yeah, I'm gonna bail on the what the presentation is, right?
Okay.
Because, and we'll just go with the questions, because okay. I think that right. This is gonna probably illustrate that more than the. I'll make sure that you guys have access to the content that's in the presentation. I'll send you the link to that. But let's just go through the questions here with the time.
Okay. So this is something that you would normally get to in your presentation anyway, but any recommendations for investment types for saving for the tax payment at time of forgiveness, other than simple savings account, which of course have very low rates currently?
Yeah, I do. And that I am going to come back to here for this. So I have a slide for that has some suggestions. So, so the first thing to do is start with Bankrate or NerdWallet and look for that online savings account that's going to yield you something higher. I'm a huge fan of what are called robo-advisors. These are automated platforms where you can set up automatic transfers into them from your online savings account. And basically you tell them what your risk tolerance is, right? So I use, the one that I use is called Wealthfront, but all of these are basically the same. But basically from a scale of 1 to 10, 1 being conservative, 10 being super aggressive, I have my forgiveness savings allocated in about a 7, right? And I've been experiencing somewhere between a 13 and 15% return on that forgiveness savings over the last 6 or 7 years, which is also one of the other reasons why I'm 65% of the way to our tax target. Now that has a lot to do with the fact that we've been in one of the largest or longest economic expansions that we've ever seen, right? So we've seen some real aggressive growth in things like stocks over the last 7 8 years. I certainly don't expect that to stay that way, right? But it's nice that we've been able to experience that now. What I expected with that 7 out of 10 allocation was probably somewhere in the 5 to 7% range, right? Which is what I'm expecting probably for the duration of my forgiveness plan, right? But since I've gained some ground here, I can probably pull back on how aggressive that savings is, right? And I'm going to do that anyway, right? When I'm knocking on the door of forgiveness, and I'll define that as somewhere between 3 to 5 years before I reach forgiveness, I'm going to probably pull that back to something that's in the 1 to 3 range, a really conservative investment, right? And maybe even by that time, hopefully some savings accounts are yielding more than 0.5%, right? So I don't have to put any of that fund at risk, right? What I don't want to have happen is the stock market to tank 2 years before I have to pay the IRS and I lose 30 or 40% of the value of my forgiveness fund, right? So that's where you have to balance that a little bit, right? And if you want, you can enlist the help of a certified financial planner to do that for you, right? So once you have a target in mind and how much you want to save per month in mind, you can sit down with a certified financial planner, and that's what they're great at, right? You don't want to have to ask them about all the details of student loans because they're not going to know those things. But if you tell them I need $200,000 in 18 years and I've got $500 a month to allocate, they'll help you craft a portfolio to get there, right? That's what they're good at. This NAPFA, National Association of Personal Financial Associates, I think it is certified financial planners and generally ones who act as fiduciaries, right? So the fiduciary standard means that they adhere to acting in your best interest rather than selling you a mutual fund that they get a huge commission on, right? So ask them if they're a fiduciary, right? Because you want to know how they get paid, right? You'd be happy to pay them for their time and their knowledge, like a fee-only planner, right? But you don't want them recommending you things that they're going to get a commission on that might not be very good at all. And you have to be really careful. That financial planning industry is full of that crap, unfortunately, right? So the CFP designation helps to reduce the chance that you end up with one of those types of folks. This fiduciary standard does as well, asking them if they adhere to the fiduciary standard. And then these websites like this actually help to identify those folks who do those things in your particular area.
Okay, next one. So if my current debt income ratio is 1 and I have about 16 years left of repayment on IBR, under IBR, would it be wiser to try to pay the full loan balance in the next 10 years, or should I pay the minimum over the next 16 years?
Yeah, I would compare what the monthly payment would be to pay the balance to 0 in 10 years against what the monthly income driven payment amount is. I suspect it's going to be very similar, right? They're going to be very close to each other. So there's a good chance that you're going to end up paying your student loans to 0 in 10 years or less regardless, right? You don't have to switch plans to do that, right? Particularly in IBR because you're paying 15% of your discretionary income, right? So when your debt to income ratio is at or near 1, your IBR payment will be something close to the standard 10-year payment, right? And that means that you'll probably end up paying your student loans to 10 years, even using IBR, right? So you can choose to switch if you want. You probably don't have to. You can just keep making payments based on your income. And if there's not too big of a difference between the standard 10-year amount and the IBR amount, and you might choose to pay the one that'll get you to the 0 in 10 years, right? But that you're not really sacrificing a lot of your budget there. But if there is still a decent amount on the table, then, pay based on your income and use that difference to, shore up your emergency fund, your retirement. Does anybody here know what the maximum amount you can contribute to a 401k is? Does anybody want to try typing that in the question and answer box for the 2020 and 2021 tax year? Close. It's 19,500, right? So every year, my wife and I try to each hit 19,500 in our respective 401ks, right? And not only does that reduce the amount that we pay in taxes, it reduces our monthly student loan payment, and it helps to boost the hell out of our retirement savings long term, right? So try to hit that. And then, you all are working for an employer that provides a match, right? That's just icing on the cake, right? That just is going to add more to your long-term retirement savings. The more you can contribute, the sooner you can contribute, the more you'll have in retirement.
Okay, if someone passes away and I get a sizable inheritance, is there any scenario, we get this question, I feel like so much, is there any scenario worth instantly paying off my federal loans? Or is it best to keep the forgiven amount ready and to use the money at other debt, house, car, college, retirement, etc.? 2010 graduate with 243K principal and 600K interest on IBR.
Yeah, I would not. So inheritance is not treated as taxable income, right? So it will not affect your monthly payment under using an income-driven repayment plan. So your payment is still a function of your normal earnings. What I would probably do is take a balanced approach. I would look at that inheritance. I would use a little bit to shore up my forgiveness fund. If I'm not feeling great about that, I'm going to use it to shore up my emergency fund, saving for my kids' college fund, all those other sorts of things. Again, there's very, very little reason to put money towards your student loans that is not required, right? There are so many other things that you can do with money that are going to yield a much bigger return to you and your family in the short and long term than putting it towards your student loans, right? Once you pay it towards your student loans, you can't get it back, right? Except for this bizarro case of the CARES Act, where you might be able to get those payments you've made during that pandemic relief period to get that back, right? But normally that's not the case, right? So don't turn that money over when it'll probably benefit you and your family in other ways way, way, way better.
Okay. I'm a 2018 graduate with from an in-state school. I have approximately 150K in federal loans and 13K in private loans. My salary is 125K per year. I'm currently on the extended repayment plan. Is it more beneficial to change to IBR, cheaper monthly payments? Before the national forbearance, I was paying about $1,400 per month, $974 in federal and $400 in private in student loan payments. Is it possible for me to decrease my monthly federal student loans based on my discretionary income, single, no dependents?
Yes, absolutely. So I mean, and again, I would run that through the simulator. So a couple of things there. I'm guessing too that I didn't hear all of that. Was it 2018? 150-ish?
Yep, 2018, 150 in federal, 13 in private. And salary is 125.
Okay, yeah. So you'll want to fill these in more appropriately. So since you're on an extended graduated plan, you're not going to have any unpaid interest. I'm guessing your interest rate's probably a little bit less than some of the ones we've run earlier, just based on when you graduated. But if you've got some private loans too, get your federal student loans. I mean, you don't have to make payments towards your federal student loans now. Pay off the private loans, right? There's no reason to pay towards the federal student loans now. The private loans are probably not in any kind of, automatic shutoff or not accruing interest. So pay off the private loans now, right? And what did you say was 120?
His salary is 125.
125. So, and I'm guessing this is your gross, right? So again, I would look at, and we talked about your discretionary income is based on your taxable income. If you're, say, for instance, if you're contributing 19,500 towards your 401k, right, your taxable income would be closer to 105, right? So, um, and you'll have more in retirement, right? Your monthly payment will be lower. If you qualify for pay as you earn, I didn't catch that or not.
He said that he's in. He's currently in extended repayment. Is it more beneficial to change to IBR?
Yeah, so I'm guessing based on your graduation year that you probably qualified for pay as you earn. And if you were paying $1,400 a month before, again, just as an illustration here, if you're maximizing your contributions to a 401k and your taxable income is, $20,000 less, right? And we still assume a growth rate of something a little bit above inflation of your income, your monthly payment on a plan like Pay or Repay is going to be half of what you're paying now, right? So I would, at least in the short term, take that, right? I mean, you don't have to make a payment on your federal student loans at all, and it's not costing you anything, and pay off those private loans first. And then once you're done with the private loans, I would still probably take an income driven approach, most likely Repay, right? Because you may hit a point where your income exceeds your debt in the not so distant future. And that's where Repay tends to shine, right? You may end up paying your student debt balance before you hit forgiveness, and approximate a standard 10-year plan after that. But the the strategy there is to peg your student loan payment to a percentage of your income and maximize all of the other areas of your financial wellness until you get to a point where you're literally going through all of those 101 things and you've got nothing left on your list to do with that money other than pay extra towards your student loans, right? But there's a lot of things on that list before I would get there.
Okay. Let's see another one. If I converted to private student loans a few years ago, is there any programs or tips for us, or are we just at the mercy of the loan we signed?
Well, you're not just at the mercy of the loan you signed, right? We are at the we are in the literally lowest interest rate environment that this country has ever seen. So if you can refinance those loans into a better deal, do it, right? Go look for a lower interest rate. If you've got a cosigner on the one you've got now, look for a loan that gets that cosigner off the hook, right? I mean, go shop around for other private loans that are better than the one you have now. But you are kind of stuck with shopping around for other private loans, right? So look for the best deal that you can get. Make sure you scrutinize that contract closely. You may even want to pay a lawyer to review it for you to make sure that you're not signing something that puts you at more risk than you were at before, right? So go look and see what you can find in terms of a deal, right? I mean, I think that, this is, again, lowest interest rates ever. So this is a great time to try to lock in some kind of fixed rate based on your credit history score and loan amount and all those sorts of things, right? So if you can get a better deal, go for it.
Okay, next question. What happens if you're in income driven repayment and make around the average 105 salary, but have a year where you have additional one-time income for some reason that affects your debt to income ratio? How does this affect repayment going forward? Can you re-enroll on the same time clock, or would it reset?
I'm not sure I understand that one.
So I think what they're saying is, like, they make regularly 105 a year.
Mhm.
Let's say in 2021 they make 120 or 130 or 140. And then that goes back down to 105 the next year. How does this affect repayment going forward? And can you enroll on the same time clock, or would it reset? Like, does that 1 year of increased income change your debt to income ratio?
No. So you're,
I think that's what they're asking, but it was anonymous. So if you want to
let me, so
something, let us know.
if you, I would encourage you to look at the application for the income driven plan. So that's also on studentaid.gov, and you can look at the there's a bunch of electronic ones here, but here's the form, right? And you have to renew your income documentation at least once a year. Now, again, in normal times, the pandemic, you don't have to worry about submitting your income documentation right now. Everything is on hold, right? But normally, and when we do re-enter repayment, they're probably going to require us to submit some new income documentation. But they're going to ask you in the income section, not only, are you married and does your spouse have student loans and how did you file your taxes, but they're going to ask you, did you file a tax return in the last 2 years, right? And if so, right, they're going to use that tax return. Right? They're going to ask you, did you file a tax return, and has your income significantly decreased? Has your income significantly decreased since you filed your last income tax return? Right. So in this case that you proposed, if you had a one-time boost, maybe a signing bonus, whatever, that increased your income above what you normally earn, and you filed a tax return before that was on there, then that prior tax return, the answer to this question is no, right? So they're going to use that tax return to figure your income. Now, when you do file that tax return the following year, that does have that one-time income boost on it. Now it's going to say, now you're going to say, yeah, I filed my tax return. Has your income decreased since you filed that federal tax return? Now you can say yes, right? So if I have a tax return that reflects a one-time, I'm just going to say signing bonus, right? Because that's probably the most obvious example, right? So if I got a $10, $15, $20,000 signing bonus that's on my tax return 1 year, then I don't have to use that tax return to document my income. I can say that my income has decreased because now I have a year that doesn't represent that signing bonus year. And then they'll ask you to provide a pay stub, right? So you can submit the pay stub and your income will then be based on your kind of normal calendar year income. So it won't change at all, right? So there are so many ways here to, avoid, if you will, having that one-time income increase hit your student loan payment for a period of 12 months. Just by reviewing what the income documentation form is looking for, right? So you can use your tax return as long as that tax return is a reasonable representation of your income. If your income has decreased since you filed that last tax return, you can use a pay stub or some other documentation of income instead. But I will say, generally speaking, the tax return is kind of like the gold standard, right? If you submit a tax return, they'll always accept that, right? And you can do that electronically too, which makes things a lot easier. So unless you have a really strange circumstance where you have a 1 year period where you have a really high income and then back to normal, then you might not use a tax return. Does that make sense? I hope I answered that question. I would, I would read the income driven repayment plan schedule. I would also, everybody here, before we leave, if you upload your file here and you're logged into VIN, right, you can actually, if you have specific questions, right, if you want personalized assistance, which a lot of this is kind of getting into that realm here, that's really hard to do on the fly, you can post on VIN, right? So we have a student debt folder on VIN. If you're logged into the Student Debt Center here, you log in the same with your credentials. If you go to the student debt folder, this is where you can post anonymously, and I can use the information that you provided in your student debt and income signalment to answer your questions. So essentially, you would just post your questions in here. Oh, sorry.
That's gonna be overwhelming for them.
Yeah. So, but you can post anonymously, right? So here's a few questions and answers that we've been going back and forth with people on. Here's a person that's got $350,000 of student debt, was having trouble calculating their debt to income ratio, wanted to know how they were doing with working towards forgiveness. So we went through and did all of that analysis, right? So we used their student debt and income signalment, right, that they filled out, the same form that you guys all filled out, right? And we go through and we answer those questions that are in there, right? And we use the numbers. I can provide actual simulations using the numbers that you provided in there, rather than me kind of hacking my way through them now based on what you're telling me in the Zoom chat. right? But we can do this in way more detail here. And this is open to VIN members. If you have an active VIN membership, it's also open to non-VIN members, right? So as long as you're a veterinarian, we have a way to have you post, even if you're not an active VIN member, right? So I would, reach out if you're interested in that personalized assistance, or you can log into VIN, navigate to the student debt folder. Easiest way is probably through here. If you click on the student debt folder, it'll take you right there, and then you can just post your discussion.
And you will only see that once you're logged into VIN, but if you have questions, you can always email studentdebt@vinfoundation.org too.
And then here's the little anonymous checkbox here. So if you don't want to have your name associated with it, I'll still know who you are, but the rest of the community won't know who you are. And you get the answers that you need, and then everybody else gets to learn from the collective experience that we've all. I mean, there are hundreds of these posts in here, right? This is where we get all of this information that we pass on to you, is working through these cases in detail with our fellow colleagues, right? So that's where all of this information comes from.
Okay, we have one more question. What happens if you're an income-driven repayment and make around the average? Oh wait, nope, this was it. Sorry, same question we just answered. I'm like, this sounds familiar. So I think we're good. I think we have all the questions. Does anybody else have any other questions?
Yeah, I mean, thanks everybody for sticking around and for being engaged, right? I mean, that's really what we want these things to do, is to help you get those questions. But when they do kind of step into that realm that exceeds what we can really do in this Zoom format, that's where I would really encourage you to head on over to the VIN student debt folder, and we can really dig deep into those questions that you asked and the specifics of your circumstance.
Absolutely. Tony is here as a phenomenal resource, and there's so much to learn. And you really have the opportunity to save tens of thousands, if not a lot more.
Yeah, no, I think it really comes to to me, it really was eye-opening with the beyond the student debt, right? So the stuff that's on the screen now is really, it really helped us with saving for a home and boosting our retirement savings and saving for another home. And, all of those things became really easy. And it's amazing how, everybody wants to know how to snowball their student debt. You should really worry about snowballing your financial wellness, right? Because you'll be amazed at how much that stuff can grow and how quickly it can grow. And your student debt just becomes kind of like a blip on the radar, right? So it's just a tiny, fraction of what the overall is, and then you just keep managing it, right? Whether that involves forgiveness or not. If it does, be prepared for it, and if not, congratulations, you paid it off, and either way is fine.
Wonderful. Somebody just wrote, thanks, Tony. I'm going to call my provider first thing and get that money back and invest it.
Great. Excellent.
Okay, everyone. Thanks so much for being here. I want to be respectful of people's time. Thank you so much, Tony. Is there anything else that you wanted to say?
No, thank you, Jordan. And, thank you, Matt, if you're still here. I think you're still behind the scenes there.
Yeah, he is.
Thanks, Joanna, for sticking around too. So I appreciate you setting this up. And yeah, if you guys have any more questions, please feel free to reach out, and we'll do our best to answer them.
Yeah, and we will be providing a recording of this presentation, but also, since we sort of shifted a little bit, we will also provide a link to this Prezi presentation, so you also have access to the full presentation also. And Joanna will be sending that out. Is that correct, Joanna?
That is correct, Jordan. Yes.
And okay, there is a question right now about how do you get the CE credits. Joanna's also going to be sending out an evaluation form. You need to fill out the evaluation form, and once you have, we'll be providing a CE certificate to Joanna for you as well.
Absolutely. Thanks so much. Great information. Everyone have a good night. Stay safe.
Wonderful. Thanks, everybody.
Bye.
Bye.